Hello, and welcome to the Get to Know Hedge Fund Investing series with Carl, the Carl Investment Platform. I'm Jamie Effenberg, and today we are starting to go through individual funds. We are going to start today looking at Kilimanjaro. Now, due to regulation and investor accreditation, if you did want to go through and look at an actual, what we call the old school performance report with one of us, please go to the website and go to talk to Carl. I won't be able to show the statistics or graphs in this series, but we can always go through that with you one-on-one as an investor. So please keep that in mind. I'm going to talk through this as best as I can. And the goal is that this will give you a foundation to be able to look at the funds yourself within the Carl mobile app. And so with that, in the Carl mobile app, you're going to go to Analyze, and it looks like a little magnifying glass in the bottom middle icon, and select whichever fund you want to look at. That's Explore. And most of these statistics are in the information section, but you have a lot of information within that Explore section for each individual fund. You can then put funds in a portfolio and look at the statistics of the portfolio, which I mentioned in the last session, that looking at multiple hedge funds together can still be a strong statistical view and opportunity to outperform the market if that's what you're looking for. And to Kilimanjaro. So I start with Kilimanjaro because first and foremost, it's a great, people see it as a great diversifier. It's a commodities-based hedge fund. And a lot of folks, they would never get into commodities on their own. It's tough. You have to know what you're looking at. This particular fund will invest in over 30 different commodities. And so when we're talking about that, it's energy, agriculture, metals, crude oil, sugar, copper, gold. They'll play in any of that. It is a long short, so they look to perform in all types of markets. As I look at, and I'm looking at the last 4 years plus the year to date when I'm looking at a fund overall, chatting with you in these sessions, Kilimanjaro, you'll see right now it's hanging out around the S&P in the growth and annualized return category. But as you look at it historically, you'll see that it often will go above the S&P, particularly when the market is down. So it has that uncorrelated aspect that this can give you, it can keep working for you in your portfolio, even when the equities market, even when your stock portfolio is down. That's a factor here. And then when I look at its risk profile, it is in several categories really outperforming the S&P. And this is what investors are often looking for. What's the return opportunity and how much risk am I taking for it? So for instance, the worst drawdown for Kilimanjaro here in this period is around 15%, and the worst drawdown on the S&P is 33%. So that's quite different, right? And the largest monthly loss for Kilimanjaro, around 5.63, and the largest for the S&P is 12.51. So it's reducing risk, and yet it's giving a fairly consistent return profile here over the period I'm looking at. Now, when you go into the mobile app, you can look at specific periods. So a lot of times investors immediately go to February, March of 2020, when COVID hit and the market it was an unusual market and it did go down, and they look to see how funds perform during that time. You can look at that or any time period in the 4 years and current year to date. So with this, other items to mention within Kilimanjaro, this is commodities. They are taking advantage of price differentiations within the commodities markets, price dislocations. They have proprietary algorithms that are seeking out these patterns. And an example of a pattern is corn. Corn is used for animal feed. And when there's a drought and large crops are getting destroyed, that means that corn prices are going to rise. And one of two things will happen. a new supply will be found, meaning an existing inventory, or there'll be an overseas import or something along those lines, or there will be reduced demand as different grains get substituted for corn. And so these are the types of factors that the Kilimanjaro algorithms take into account and begin to make investments in and around. Whether that's long or short, they will do either. So they look to profit, and as I just said, they're looking to profit in both the rising and falling markets. And because they're not even correlated to commodities indexes, they're really going to perform on their own. And so as a diversifier, most people see this as a strong option and a way to get into commodities that, to be with a pro investor, an expert investor who's been in commodities for years. Joel Morang is the manager here in coordination with James Dedman. You should take a look at their podcast. They obviously know the commodities market better than you or I. And so I feel better being in this investment with professionals, because I would never go into commodities on my own. Great opportunity. And I hope you take a look at it and see if it's right for your portfolio. We'll go through the next investment next time. Thanks so much.